And we're live. Welcome back to another episode of Gimbal Weekly Updates. I'm Amanda Repass. We've got Keith Tyner.
Hey, how's it going today?
Good. Debbie Cash.
Good morning, everybody.
And Douglas Shreve. Where are you joining us from?
Hello, everybody. I'm in the great outdoors, and all of you should be too.
That's awesome. Well, I'm just going to start off real quickly with our disclaimers. I'm going to try to read it as best as possible. Content provided at the event is for general information only and not intended to provide specific advice or recommendations for any individual. Any performance reference is historical, no guarantee of future results. All indices are unmanaged, may not be invested into directly. Any economic forecast set forth during the event may not develop as predicted, and there can be no guarantee that any strategy will be successful. These thoughts and opinions are those of Gimbal Financial and do not represent the views of LPL Financial. Securities offered through LPL Financial, a member of FINRA and SIPC, and investment advice offered through Gimbal Financial, a registered investment advisor and separate entity from LPL Financial.
You do that like you've been practicing it, Amanda.
I think each week just gets better and better. I conquer my fears a little more and more because I'm in Doug's boat. I would have, growing up, I hated reading in front. Popcorn, worst experience of my elementary.
I don't even know what that is. What is that?
Oh, you like popcorn, and it's like a mystery as to who's going to read next, but you get to decide. So you could read as much or as little as you want. Anyways.
So if we bring microwave popcorn in here, that's not going to cause any problems, is it, Amanda? We're going to be all right?
Okay, now you're just bringing up PTSD for me.
That's an inside joke. Anybody who wants to stop by the office for popcorn, make sure Amanda does not cook it for you.
Yeah.
Exactly.
Hey, I want to say welcome to Friday. This has been going on for several weeks now. We've been doing these Zoom webinars, and we've been getting a lot of great feedback throughout the week. I know some people tune in live right now, and we really appreciate you being here. And more are tuning in by just going on to gimbalfinancial.com, the blog section, and then watching a portion of this. Maybe you don't watch all of it. I don't know. You might catch a snippet, but we really appreciate it. And thanks for giving us some feedback, letting us know that you're tuning in and you're picking something up from this call. We really are glad that you're here. And our goal through all of this is just to help educate each other on what markets are doing, what investments are doing, our culture. And it's just been a blast to do it with you. Some days are better than others. Yesterday in the stock market was just painful. It was one of the more painful days that I remember. There was no relief in sight yesterday. And so we're going to have days like that. And it seems like, especially when we go through extreme volatile times, just to even expect pullbacks is probably a realistic thing to put into your mindset. And so I just want to thank you all for tuning in. And today we're going to do what we always do. We're going to talk about the market. We're going to share the wisdom that we do know. And if you have any questions or feedback for us, thoughts that we need to be considering, always feel free to email us.
Debbie, what do we need to know? Anything you've got for us we need to know about our service model and how we're serving clients?
Nope, we just always try to do our best. We try to get everything out as fast as we can. Sometimes that gets a little difficult with the people we have to work with, but I was impressed once this week with.
When you say people we have to work with,
that's what I was thinking.
I don't want to mention any names.
People we have to work with.
Is it time we put Debbie into her role as attendee now? Debbie, we'll see you later.
Thanks for be on here.
Thanks for joining us.
Okay.
Was that rude of me, Doug? I don't know.
Hey, I mean, you did what you had to do. I mean, she obviously called me out.
I
know. Sorry, Debbie. Man, that's like what a radio show people do. If they don't agree with their opinion, they just disconnect them right away.
She's gone. It's almost baseball season, right?
Yeah, yeah. Well, hey, where should we start? Should we dive into markets and share a screen, see what's going on? I'll share my screen here. We're going to take a look at the NASDAQ. We're going to take a look at the S&P 500. And
Doug, you were, I don't even know, like I couldn't necessarily agree completely with you yesterday, or what you said about the market happening yesterday. I was down in Evansville and had some flashbacks. I think playing sports was a little more violent than I remembered. Have you ever been punched in the face, Doug?
you know what? Thankfully, hard times at Muncie Central High School. I never was punched in the face. No.
Yeah, I got my fair share of those, but yesterday in the market felt like one of those days. It was amongst some of the most brutal days probably in the history of the market. So it was a bad day yesterday.
Yeah, no doubt. It was a bad day yesterday. Let's take a look and see how bad it was. Okay, let's see. Okay, so we're going to take a look here. And this is going to be the NASDAQ. And what we like to do is we like to take a look at the NASDAQ. We like to take a look at the S&P 500. And then we also like to look at some smaller and medium-sized companies. So as you can see, those of you who have been on this call before, you're starting to get familiar with what all these lines mean. And this one is yesterday, this reddish pink line on the NASDAQ had a little bit of a gap in between. What does that mean? Keith, what does the gap mean?
A gap is a space for which there was no demand yesterday, no demand for those shares of stock, which means that it's just like, I've never jumped out of a plane, but it's what you would call free falling. And I listened to a little Tom Petty last night because it was free falling. So that's what happens there. If you go to the left over on the screen there, Doug, and point out in March, we had a number of free falls going on through the market there. And ideally on the inverse where it's going upward, there's a gap there too, and that's where there's big demand for limited supply of shares.
Yeah, I'd like to see one of those again soon. Yeah, so we had a gap opening basically, and the real interesting thing that I was watching all day yesterday, and Keith, I'm sure you were too, is if you notice these vertical lines all have a horizontal bar. That horizontal bar is where the market closed, where the NASDAQ in this case closed. And so if you look, this one here closed in the middle. Day before it was near the top. Day before that it was exactly at the top. Well, that's what you want to see when things are running good and markets are having up days. You like to see it closing at the top. And when you're having a down day, you really don't like to see it closing at the bottom because that tells me that had this thing stayed open for an extra hour, it would have kept going down. Thankfully, we met to 4 o'clock, and isn't it interesting how this index decided to close right at its 20-day moving average. So many times when Keith and I are looking at markets, we see that stocks, markets like the NASDAQ, maybe an ETF, like a healthcare ETF, they tend to fall in line on the tough days right at a major moving average. And that's a great sign. That's a sign of a relief. And so what we will be looking at over the next couple of days is to see how will these indexes do? Will they fall through major moving averages, or will they bounce off them like we're seeing today with the NASDAQ? Any other thoughts on that, Keith, before we switch over and look at the S&P?
Well, I think if you go back over to the left, right at the, I can't see, your screen has all those stocks, and I can't see the dates there on the chart. Yeah. But if you go over there to about, it looks like about the 21st, maybe the 21st of February right there. If you keep going to the right just a little.
Oh, I was close.
Go to the right where it bounced off.
Mouse.
Right. It did. You were talking about those averages, and now I can't see what I wanted to show, but right on about the 21st of February, just past that, it bounced off the 200-day average there, where it gave us hope that this sell-off that happened started in late February was going to come to an end. Had a couple up days, and then all of a sudden the sellers just jumped on the market. And what ideally I'd like to see here is this thing just settle down, but it's probably going to be pretty volatile the next few days.
Yeah, I agree. I would love to see this settle down where we don't have a lot of volume coming in, and the prices just stay unchanged, you know, move within 0.25% or so and just level off, allow people to settle down. I tend to think that part of this rally, and I'm going to switch over to the S&P 500 right now. If you've been on this call, you know that the NASDAQ really exploded after the March lows, and the S&P 500 has taken a little bit longer. The S&P 500 isn't all tech stocks or, you know, healthcare stocks. It's got everything else. It's got oil, it's got the airlines, it's got the cruise lines, it's got a whole bunch of different companies inside. And those companies took a little bit longer to rally, but when they did, we went right through the 200-day moving average. And what I think tends to happen from time to time is when these stocks that have just been beaten down, maybe they don't have the earnings or the sales, but their prices just got beaten down out of fear. The bottom feeders come in, start snatching them up. But the moment there's weakness, those folks are quick to rush to the door. And so that's something that we started to see with some of the maybe weaker rallying stocks. And you can see the S&P 500 went right back to its 200-day. Any other thoughts on that, Keith?
No, I just remember we got a weekly update coming here. I just, oh, that's on my screen. You don't see it. I just remember a couple of weeks ago or 3 weeks ago, we were talking about we'd like to see this thing get over the 200-day moving average, and it shot off like that SpaceX once it got over it. And today's given us some encouragement. It's probably going to stay over it, but the next few days will probably let us know. It'd be nice if it looked more like to the left of your screen over there. It was pretty steady in the second half of last year, just trending slowly up.
Yeah, that's a much better picture.
Yeah, a few weeks ago I mentioned that I don't like long lines, and if you look where the market started selling off in February, the lines for each day of activity were really long, although pretty much all the way through beginning of May, the lines started getting a little shorter on the daily fluctuations. But I like it when it looks more like the second half of last year, where each day's trading range of the stocks is really short. And we were kind of getting that the last few weeks until yesterday, and then we got another long line in there.
And those lines are just what that means is the prices were pretty wide, and so
during the day.
What's the difference between the blue and the red?
Yeah, great question. So, you know, the blue, that's up, the red, that's down. We like blue.
My favorite color.
And it's up where it closed the day, because some of those blue lines, like where your cursor is, were almost the same all day long, but they closed at the high end there where they went blue there.
Yeah. Let's take a quick look at the small cap stocks, medium cap stocks. Okay, here we go. So this index had been rocking and rolling. It had really been great. It peaked above its 200-day moving average, which again is something we really like to see. Here there wasn't a lot of movement. That line is not long at all and closed at the top. But then next day started to bleed off a little more, and now we're well under its 200-day moving average. I'm thankful this didn't bounce all the way to the 50-day moving average, but it did dip below the 200. So this is one that we're keeping our eye on. Kind of expect these smaller companies to behave this way. They're a little bit more volatile than some of the bigger and established companies out there. Any other thoughts on the market before we move forward?
Yeah, well, I'll just share them on my comments. I'll offer some thoughts on that process. And
okay, I'll stop sharing here. Amanda, what are you looking at today? What's going on in your world?
Not a ton of new stuff. Debbie pointed out a good thing about the service of just what we try to do best at Gimbal. But an update personally is I have been taking your advice and quit something. I actually quit it a couple weeks ago, but I quit my gym. And I'm
Nice work.
thankful. Corona has taught me that I definitely don't need it. I can do almost everything that I was doing in those classes, either in the great outdoors, I can do it in my living room, I can do it in my basement, I can do it anywhere in the world. And it doesn't have to cost me a pretty hefty, expensive monthly cost. So I
Way
feel
to go. That's a big
like
deal.
a weight is lifted. Yeah.
You feel like a weightlifter? Is that what you said?
There's a pun intended. But yeah, did you guys quit anything this week?
You know, I was thinking about that just yesterday. I'm supposed to quit things on Thursday, and I hadn't quit anything, so I'm going to have to come up with something this Friday. But I've quit several things over the last month, and it is freeing. Probably the best benefit is just reducing my technology exposure. I think I may have told you I quit Instagram.
Yeah.
It's
that's a
nice.
big one.
Nice to have that time in my life back. And I took the Facebook app off my phone, which has been just another freeing thing where I just don't have to be distracted by either news or someone else's opinion. And so anyway, yeah, being free, that's the goal.
Cool. Keith, you got anything?
No, I was a keeper this week.
Nothing wrong with that either.
I'll give away a couple books here later, so that'll get rid of something.
Cool.
Well, last week we spent a little bit of time talking about changes and what's going on with COVID-19 and how we're being affected by it, what markets are doing and how they're responding. And, you know, Keith and I talked a little bit about what types of things may come back or may never come back, or what's accelerating. And today in Indiana, it's a big day. We go into stage 4 of this COVID experience, and movie theaters open up. I don't think I'm going to the movie theater tonight. I'm going to follow the market, and I like Netflix. Don't buy Netflix stock. That's not a, but I might watch some Netflix. But Keith, what are you thinking about in markets in general and financial planning? How's this all fit together today?
Yeah, no, it's there's a chart behind me of the market over the last 100 years, and I just kind of took a glance at it before we started, and just there's all kinds of volatility in our world today, but that's really not anything new. There's always volatility in the world, and you know, we're generally at world peace right now. It probably doesn't seem like it to a lot of us, but those things can really mess with your psyche. And I'd like to just be an encourager to all you out there that there are great things in front of you, and just to try and encourage you to just keep a positive attitude and not dwell on the news, because that can sure cause some ailments in your world if you allow it. And specifically to the market, I've brought up this chart pretty much consistently. This is called the volatility index. The VIX is what they call it. And over here, can you all see this, Doug? Is this?
Yeah.
Okay.
Yes.
So this is all the way up until February. This VIX index was ranging between like 25 and down to 12, and it just shows you how much the market's going to go up and down right at this point in time. And then all of a sudden, things got really hectic over here in late February, and then into March, it hit probably the highest it's been in 20 years. Well, it might have hit this similar level in 2008, but it just shot up, and portfolios were having a difficult time through that. And then the volatility has dropped off. And normally when this volatility is flat like this, it's a lot easier time to make money in the markets. We had a brief period during this decline here, but with those big lines that you see in the day-to-day volatility in stock prices, it still can be a little challenging. And so that was probably the disappointment of yesterday, is just to see the spike in the volatility. I was kind of excited. We were getting, this black line is the 200-day moving average, and it just tells me, yeah, we're about average volatility for the last 12 months. And then we jumped up almost 50% yesterday, which is a big spike in volatility. So when you have when you have these big volatile times, one expert trader says those are what you call hard penny markets. It's really hard to make a penny out there, and these type over here are what they call easy dollar markets. And so it's during these volatile times where Doug and I really earn our money, because we're having to make some difficult decisions sometimes when the volatility, when things are going smooth, we can pretty much keep our investment decisions on autopilot and not have to make too many changes. So that's maybe if you've seen some confirmations in your email or in your mailbox that we've done some transactions, that maybe this particular screen can help you understand what causes us to do more. We're in a normalized market, we're going to do a lot fewer transactions. And so that's one of the things that are out there. I thought I'd also point out, it's just our culture has always been disagreeable at some level. And so what people don't maybe always understand is that here's General Electric, and you can agree with me or disagree with me on what you think about General Electric. But each one of these lines you talked about a while ago, Doug and Amanda, that, like this line right here, there were, on that day, it says there were almost 46 million shares of General Electric that changed hands that day. And when you hear somebody say that they changed hands, that meant there was a disagreement. Have you ever thought of it that way? That in order for somebody to sell their shares, somebody had to buy it. And so somebody thought it was not a deal, and somebody else thought it was a deal at that level. And so that difference of agreement took place out there every single day. And just like in life, the disagreements doesn't mean that at any point in time somebody's right or wrong. Maybe sometimes there's just a misunderstanding or something. And so in the stock market, it'll eventually tell you whether you're right or wrong when you exchange hands with it. And this stock is one that people love, General Electric, and we're not recommending selling or buying it. We're recommending you talk to your financial advisor about it. But we could pull up this screen on this one and look at the trend since 2016, or the trend of this one since 1997. And the trend of this one would suggest that if you were trying to make money and buy and hold this stock, you probably have not got anywhere for more than 20 years on this thing. So yeah, every time you hear that somebody bought shares of the stock, there was always a seller on the other side. And so there's always a different opinions on stocks. And so Doug and I and Amanda and Debbie, we've put ourselves in a place to have an agreement of what we believe is best for you when we do managing of your accounts. That's the primary thing I was thinking of today, Doug.
Man, that sounds like a preacher.
Preach it, man.
Preach it, brother. Yeah, no, that is so true. And boy, what a parallel to life out there. That's good stuff, Keith. And it will be okay, folks. We've gone through times like this, and we don't know what today holds. We don't know what next week holds, but I guarantee you that we'll have some opinions about it, and we'd love to share it with you. We're also, we've been humbled a time or two, and so we will listen to you, and we want to hear your feedback on what you think about markets, and it's your money. It's your money, and we just appreciate you trusting us to navigate these times with you and make decisions on your behalf. And so, yeah, I was on the phone with a guy the other day, and his son is 17 years old and very interested in stocks. And he asked me, he's like, why do you like stocks? And it was a great opportunity just to go back and rethink, why am I doing this in the first place? And I want to encourage you, as you think about your money, what it's for, how it got there, just to go back and say, what is this for? How did this accumulate? And really think through it. Think through what you want the future to look like. Map it out. Maybe tie people to it. But for me, if I go back and I say, why do I really like stocks? The heartbeat of it is ownership. When you can own a stock, you are an owner of a company. I like to tell my sons, we could own Apple. We could own Tesla. We can be a part of this awesome new tech economy if we want to be an owner of it. And I look back in my family's history, and my great grandmother, she started a beauty school in the late 30s and early 40s, pioneer businesswoman. And she created a legacy for my family. It was one where we believed that ownership had value. I can remember when I started working with Keith and with Jim Pinkston, you know, they would say, hey, have an ownership mindset. And really what that meant was if there was a Coke bottle out in the parking lot, pick it up, put it in the trash. And I just want to encourage everybody that you are owners with investments. You are also stewards of this great society that we live in. And as you're getting outdoors this weekend, it is going to be one of the best weekends ever in Indiana. Wherever you are in the world and in the country, I hope it's beautiful there too. But today is so beautiful. And just the idea of an ownership mentality, you might be the one picking up a Coke bottle today. Or you might be the one to encourage somebody and say, hey, check this out. Can you believe we get to live here? And so just like the stock market, we're going to have some bad days, but there's plenty of good days around the corner because we live in a fantastic place. We work in a fantastic place where ideas are exchanged in the marketplace, and there is a buyer and there is a seller with conviction that each of them knows why they're doing it. And so go back and revisit your why of why you're investing. Anything else before we close out the show today?
I've got a couple books to give away, Doug. Along with one of the books is the idea of I've thrown out some ideas of some interesting either videos or podcasts. There's a podcast out there called Free Brian Williams by Malcolm Gladwell. So this is Gladwell's latest book.
That's a good one. I like that podcast.
Yeah, Talking to Strangers, his latest book. I read it. It's classic Gladwell. It's an okay book. I read it. If you like Gladwell, it's all right.
You're giving away okay books.
Well, I mean, it costs you $30 or whatever on Amazon or whatever, but it wasn't his best. But it's worth a quick read. But his Free Brian Williams, I like that podcast a lot because I don't always like Gladwell's opinions on things, whatever, but that podcast taught me that I'm wrong. and most of us don't like that. I don't know about Amanda or you, Doug, but like to think that I'm wrong. But that podcast convinced me I'm wrong. Not all the time, but I'm wrong more than I probably would admit. And so that's a good podcast if you want to look at yourself in a humble, honest way. And you have to give it the time to process it. And the second book is I've enjoyed some of Michael Lewis's stuff, and this is Moneyball. And Moneyball irritated a lot of baseball fans, I think. I don't know. Did it bother you, Doug? Did it?
I haven't read it.
Oh, okay, yeah. So it reminds me of some of the decisions we've made on your behalf. Is that we're not doing things always the traditional way here. We've been really studying a lot of the numbers behind things and trying to do things on a more statistically advantageous way for you. And that's what Moneyball was all about, is that the general manager started looking at the data, and instead of picking players that the scouts said were the best players, he looked at the data to actually see if that was true or not. And that irritated a lot of people. And so Doug and I and Amanda and Debbie, we sift through a lot of data on your behalf and try to make the best decisions we can on that. And so those are two good books I'll give up this week.
That's a good word. Yeah, a lot of things can humble you in life, and especially the stock market. I was reading a blog from one of the traders I really like, and on his blog, is either today or yesterday, he used the word "my bad." Or he said, my bad. He made a bad trade. And that was so refreshing for me to hear. So anyway, hey, Amanda, anything before we close out?
Nope. Just thanks to you guys, and thanks to our clients as well. I know you guys have put a lot of brain power behind all of the decisions you guys make, and it's much appreciated.
Well, thanks everybody again, whether you're tuning in live or on the replay. We really appreciate you. Can't wait to hear from you. and just get outside and have a great weekend.
See y'all soon.